And again with Bill Poulos now on segment 4 of our series on 5 key mistakes that traders make. Bill, today you wanted to talk about profit taking and protecting gains in a trade?
Yeah, this is another one that vexes a lot of traders. Once you get into the trade, the question now is, what do you do? How do you manage the trade? And what undisciplined traders do without a good exit strategy, is start making mistakes right off the bat. For example, if the trade starts moving in your favor, there's a tendency to take profits too quickly and lose the chance for a mega move where the market just dramatically moves in your favor, where you can take great profits. And if you take profits too quickly, you never have that opportunity. And then on the other hand, the trade moves against them, and they're reluctant to put a stop in because they don't want the pain of being stopped out, because they think they got to be right every time. And so they let the trade move against them, and then it moves against them some more. And now they're in a uncomfortable loss position, and they don't know what to do. They're frozen. And usually what they do is they overstay it, and the market goes against them even more, and by the time they bail out, they've been hurt. They've hurt their account with that one trade. So in addition to putting an initial stop on within the risk tolerance parameters of risking no more than 2% of your account size, you've got to have a good exit strategy on the profit side. And the dilemma there is, do I let my profits run, or do I take my profit after a certain point? And what we do is recommend a 2-step scaling strategy where you scale out of the trade profitably in 2 steps. First, at a profit target. You set a predetermined profit target. Let's say it's 10% above your entry point. And if the market does move that high, if you're a long position, or down if you're in a short position, if it moves 10%, you take half your position off the table right there. No ifs, ands, or buts, no wondering, is it going to go higher, is it going to go lower, what's going on? You take the money off the table. You do 2 things when you do that. You pocket a 10% profit on half your position, and you've reduced your risk in the trade. You've cut the risk in half. That's really powerful. Now you're still left with the other half position. Why? Because you expect that the market will continue to move in your favor, and you'll make even more money on the second half position, and you protect that one with a trailing stop. So as the market moves higher, you move the stop up, locking in more and more profit, and when it eventually is stopped out after the move is over, then you're out of the position altogether. Oftentimes that second half position brings in a profit that's a multiple of the first half, because you can have a 20 or 30% gain on that second half. Now, if the market doesn't move higher from that point, you still got your trailing stop in there, and if the market drops back from there, you stopped out on the second half, maybe with a lesser profit than the first half, the 10% profit target. So either way, you always know what to do. You don't have to guess. You don't have to wonder. You take half off at the 10% profit target, or whatever percent you feel comfortable with. Trail the trailing stop on the second half, and just make your adjustments every night after the market closes. Don't listen to another thing. Don't listen to any feedback or forecasts, or ain't it awfuls, or ain't it great, or whatever else that comes from the media about the market. Just follow those rules. And that's the way a disciplined trader manages a trade profitably.
Thanks, Bill. We'll see you again shortly.